Welcome to Tesla Daily News Podcast. It's Wednesday, January 20th, 2026. Today, we're tracking the biggest Tesla stories that could move the stock, from China competition and Europe's EV tipping point, to Robotaxi economics, software monetization, and key signals investors want ahead of upcoming results. Story 1: Tesla's premium sedan lead in China just cracked, and that's a big deal for the global growth narrative. Here's the context. China is Tesla's most important EV battleground outside the US, and the Model 3 has been one of the company's core volume and margin levers there. The details. Multiple reports cite Chinese Passenger Car Association data showing Xiaomi's SU7 sold about 258,164 units in 2025, versus Tesla Model 3 sales of about 200,361. That's roughly 30% higher for Xiaomi, and notably, it's the first time since Tesla launched Model 3 in China in 2019 that another automaker outsold it in the premium electric sedan segment. Impact for investors. This raises two immediate questions. 1. Price and margin pressure. If Tesla responds with incentives or price cuts to defend share, gross margins can compress. 2. Demand durability. If a new entrant like Xiaomi can scale quickly, Tesla's default premium EV status in China looks less secure. That can ripple into analyst models for China deliveries and average selling price. Takeaway: watch for Tesla commentary on China order trends, incentive intensity, and whether Model 3 gets a demand refresh or feature-led differentiation to protect share without sacrificing margin. Story 2. Europe just hit an EV milestone, but Tesla's share is slipping amid heavier competition. Context: Europe has been a key region for Tesla's Model Y, and it's also where regulatory tailwinds have historically helped EV adoption. Details. Reuters reporting cited December data showing fully electric car sales in the European Union overtook petrol car sales for the first time. At the same time, the report noted Tesla's market share declined as competitors like BYD and Volkswagen gained ground. Impact. The EV adoption milestone is structurally bullish for the category: more EV buyers, more charging build-out, and a more normalized electric market. But it's not automatically bullish for Tesla if share is falling. Investors should separate the market is growing from Tesla is capturing that growth. If Tesla is forced to compete more on price or incentives, the valuation multiple tied to premium positioning can come under pressure. Takeaway: Europe demand is no longer just about EV penetration, it's about brand preference and product competitiveness. Pay attention to any regional pricing moves and how Berlin output aligns with real demand. Story 3. Tesla is taking a more aggressive software subscription approach, and that's a margin story hiding inside a product story. Context: Tesla's long-term bull case depends heavily on recurring, high-margin software revenue, autonomy features, driver assistance, and services. Details. Reports out of Mexico say Tesla is no longer selling Autopilot as a one-time purchase there, shifting instead to a monthly subscription model. Separately, other coverage claims Tesla has removed Autopilot as a standard inclusion for new vehicles in the United States and Canada, pushing customers toward subscriptions for automated driving-like functionality. Impact. If accurate and broadly implemented, this could lift lifetime value per vehicle and smooth revenue, the classic hardware plus services model investors like. But there are risks: customer backlash, lower take rates if pricing is perceived as too high, and potential regulatory scrutiny if feature naming and capability claims are misunderstood. Takeaway: for Tesla investors, the key metric is take rate and churn. Subscription revenue is only bullish if adoption stays high and customer satisfaction doesn't erode. Story 4. Robotaxi pricing is turning into a visible competitive weapon, but Tesla's operational maturity still matters. Context: markets tend to value Tesla as more than an automaker, with Robotaxi as a core pillar of that narrative. Details. The Verge reports Tesla's Robotaxi rides are cheaper than Waymo's, but wait times are longer. It also notes Tesla's service still isn't fully driverless in the strict sense, because it includes safety monitors with access to a kill switch. Impact. Lower price can accelerate user trial and push the industry toward a price war, which could expand total demand, but it also pressures unit economics. Longer wait times signal fleet availability and operational scaling challenges. For investors, that translates to questions about when Robotaxi revenue becomes meaningful and what margins will look like once pricing normalizes. Takeaway: don't just watch Robotaxi as live. Watch utilization, wait times, and safety operations cost, because those determine whether Robotaxi becomes a high-margin platform or a low-margin transport business. Story 5. Cybertruck is expanding internationally, but the underlying demand signal in the US remains the bigger variable. Context. Cybertruck was positioned as a high-profile product that could expand Tesla's addressable market and support higher ASPs. Details. Electrek reports Tesla has begun Cybertruck deliveries in the United Arab Emirates, the first Middle East market for the truck and its second international market after South Korea. Other coverage points to weak demand in the US, with claims of a sharp sales drop in the last quarter of 2025. Impact. International expansion can help absorb inventory and keep production lines utilized, which matters for cost absorption. But investors will focus on whether Tesla can sustain demand without heavy discounting, because that impacts automotive gross margin and cash flow. Takeaway. If Cybertruck demand is soft, the investment question becomes whether Tesla slows production, adds variance, adjusts pricing, or leans on exports, and what each option does to margins. Story 6. Optimus is moving closer to the factory floor, and that's both an R&D story and a productivity story. Context. Tesla's humanoid robot narrative is part of the option value embedded in the stock's valuation. Details. A report says Tesla is shifting Optimus training work from California to the Austin Gigafactory, effectively turning parts of the production environment into a learning lab for the robots. Impact. Training in a real factory setting could accelerate iteration, which is positive. But investors should keep expectations grounded. Industrial automation is hard, and even proponents admit humanoid robots may still be far from matching human efficiency in real tasks. Near term, this is unlikely to move revenue. Longer term, it could influence manufacturing cost structure if it becomes real. Takeaway. Treat Optimus as a long-dated call option. Watch for concrete metrics, deployed tasks, hours worked, error rates, and any measurable cost savings. One more market note. Tesla stock was under pressure amid regulatory headlines tied to Elon Musk's other businesses. A report in Taiwanese financial media said Tesla shares fell about 3.1% in one session, citing an EU investigation into Musk's X platform related to deepfake concerns tied to the Grok chatbot. Even when it's not Tesla-specific, headline risk around Musk can affect sentiment and short-term trading. Closing recap. Today's big themes were intensifying China competition as Xiaomi's SU7 tops Model 3 sales, Europe's EV market hitting a milestone while Tesla's share slips, a sharper pivot towards subscription monetization. Robotaxi economics moving into the spotlight, Cybertruck exports as a demand pressure valve, and Optimus shifting toward real factory training. For tomorrow, watch for anything that sharpens the near-term numbers, pricing moves, regional demand signals, and any pre-results commentary that clarifies autonomy timelines or margin expectations. If you rely on fast, stock-relevant Tesla coverage, subscribe to Tesla Daily News Podcast and follow us for your daily roundup.